Market volatility in trading refers to the frequency and intensity of price movements within financial markets, reflecting the uncertainty, fear, and opportunity that define every trader's experience. It is the measure of how much prices fluctuate over a given period, and these fluctuations are driven by a wide range of factors, including economic data releases, geopolitical tensions, interest rate changes, corporate earnings, and shifts in investor sentiment. In simple terms, volatility represents the market's emotional pulse. When uncertainty is high, prices swing more violently, and when confidence returns, movements tend to stabilize. Traders view volatility in two distinct ways: as a risk to be managed and as an opportunity to be exploited. For long-term investors, high volatility can be nerve-wracking as it affects portfolio values, but for day traders and short-term speculators, it is often where profits are made. A highly volatile market means more potential for rapid gains, but equally, it increases the chance of losses if emotions drive impulsive decisions. Volatility is influenced not just by news, but also by liquidity. When fewer participants are trading, prices can move sharply even on small orders. This is often seen during off hours or in less popular markets. Major economic events such as central bank announcements or inflation reports can send shockwaves through Forex, stock, and crypto markets, creating massive price swings within minutes. In binary and options trading, volatility plays an even more significant role, as the direction and timing of price movement determine profit or loss within a set period. Smart traders use volatility indicators like the average true range, ATR, Bollinger Bands, or the Volatility Index, VIX, to assess risk and plan their strategies accordingly. Yet, the true challenge lies in managing emotions during volatile periods. Fear and greed often dominate trader behavior, leading to poor decision-making, overtrading, or premature exits. Successful traders understand that volatility itself isn't dangerous. Lack of discipline is. They develop risk management systems such as stop-loss orders, position sizing, and diversification to protect capital while taking advantage of high-probability setups. Volatility also serves as a reflection of market psychology. For instance, during crises or global events, panic selling can cause extreme downside volatility, followed by sharp rebounds as confidence rebuilds. Conversely, during bullish phases, overenthusiasm can inflate asset prices beyond their real value, creating bubbles that eventually burst. In recent years, technological advancements and algorithmic trading have amplified volatility, as automated systems react to data within milliseconds, often triggering chain reactions in prices. This has made modern markets faster, less predictable, and more sensitive to sudden shocks. However, volatility isn't inherently negative. It keeps markets dynamic and ensures continuous liquidity. Without it, trading opportunities would disappear and markets would stagnate. For traders who learn to read price action, adapt to changing momentum, and maintain emotional control, volatility becomes a friend rather than a foe. The key is preparation, having a clear plan before entering the market, sticking to risk limits, and accepting that not every trade will go as expected. Understanding volatility allows traders to anticipate potential breakouts, reversals, or consolidations, helping them align their strategies with the market's rhythm. In the end, volatility is the essence of trading itself, unpredictable yet full of potential for those who respect its power, manage risk wisely, and approach every price movement with patience and strategy rather than emotion.